This is my best idea in the stock market today. So in today's video, we'll be covering a few things. We'll be covering the most hated rally, my best ideas today, as well as some questions left in the comment section below. So let's talk about the most hated rally first. And this is what Tom Lee has been saying about the market rally so far.
Why don't we talk a little bit about where the markets stand overall right now? Because we're looking at both the S&P 500, the NASDAQ, and the NASDAQ 100 all closing at new highs again on Friday. It's the best quarter for technology since the second quarter of 2020. What's happening and how do you see this playing out?
Well, this is still the most hated V-shaped rally. And it, of course, has a lot to do with when stocks fell in a waterfall decline into April. Nobody likes to be sitting on stocks, so a lot of folks liquidated at the lows. But we know that whenever the VIX is above 60 and falls below 30, you've made a decisive low. And now visibility is better. Tariffs aren't as bad as we expected, and the inflation impact actually has been very muted, and actually outside of tariffs, underlying inflation is actually much lower than people expected. And I think the Fed is, even if they're holding now, the bond market doesn't believe it. If you look at the 2-year, they think the Fed's 2 cuts behind. The 10-year is now down to 4.2, which means the Fed can be more dovish in the next 12 months, and that's a tailwind for stocks.
Can you explain how we have this big, beautiful bill, which people are saying $3.3 trillion added to our deficits and everything else, and yet you're looking at the 10-year coming down?
Yes. It shows you that markets don't view the U.S.'s debt sustainability purely as its budget. Because I think there's a lot of hidden value on the U.S. balance sheet, from natural resources to buildings they own to the value of gold is undervalued.
So the markets have been melting up recently with tax cuts, with the big beautiful bill, with interest rate cuts being priced in, as well as the trade deals. But the markets are overwhelmingly bullish right now, so it's time to be cautious. I mean, if you were to look at the Fear and Greed Index, it is crazy how just 2 months ago we were at extreme fear, and now we're closing in on extreme greed right now. So a lot of the stocks have recovered fully already, and there is very little opportunities in the market today. But there is one stock that is my best idea today. So I'll be talking about my best idea today, and this stock is a Chinese stock. It is Moutai. So this stock is down around 5% year to date. It is currently trading at a 19 times earnings. So what exactly does Moutai do? Moutai sells your Moutai liquor, your Fei Tian Moutai. So what they do is they sell all these different liquors over here. The cost ranges from a few $100s to tens of thousands of dollars for the premium quality ones. And the business model is an extremely simple one to understand. So for Moutai, this is the moat of their business. So the moat of the business is a physical asset. So it's the Chishui River that they have, because they have to make the Moutai from the river itself. And it is impossible for you to replicate the taste by taking substances from elsewhere. And for Moutai, it takes around 5 years for you to make the actual drink. So it is supply constrained as well. And so when you have a supply constraint as well as some form of scarcity mindset that the company is trying to promote, it leads to a higher premium product for Moutai as well. So for Moutai, besides that, they have incredible brand value. So as you can see here, according to the rankings on Kantar, Moutai ranks 18th among the brands most valuable global brand, with a brand value of $87 billion USD in 2023. So besides that, the CCP is also actively endorsing Moutai, and Moutai has almost 2,000 years of history, which is impossible for someone to take over. So for Moutai, this is what Monish Prabhai has said about the company. He said that it is a company that is almost impossible for you to displace.
Now, if I go to my favorite stock, Moutai, do we love Moutai? Yes, absolutely. What a company. The ultimate moat, I can't think of another company which has a better moat than Moutai. Okay? Can Moutai be disrupted? How can Moutai's business collapse? What would cause the business of Moutai to collapse? So we know, if I compare MasterCard to Moutai, MasterCard can collapse. Moutai is very, very hard to collapse because of a 1,000-year history, and it's embedded in people's heads, and they have so much inventory, and the thing is, it's got all the brand cachet. China is rising. All of those things, there are a lot of tailwinds that keep coming. They can keep raising the price. Just keep raising the price. So the thing is that Moutai, phenomenal mode. So MasterCard, one of the issues is that payment systems.
So like what Monish Prabhai said earlier, Multi has an impenetrable moat. It is one of the most undestructible moats out there. And this stock is one of the highest quality businesses that I've seen out there. And besides that, there are secular tailwinds as well. So your pie chart market is projected to grow at around 7% every single year, all the way until 2032. And besides that, Multi is also able to increase their prices as well. So for Multi, they have incredible pricing power as well. So in 2023, they increased the prices by 20%. So that was the first hike since around 2017. And if you analyze it, it's around a 4 to 5% increment in pricing every single year for Multi, which is already above levels of inflation. So even if the volume slows, Multi will still be able to increase the prices. And when you increase prices, it will lead to higher growth in your profit as compared to your revenue itself. So for Multi, besides that, the company is a luxury company. They sell premium paitio. And for premium paitio, they've been quite resilient, even though in China, the alcohol market has been stagnating over the past few years. And for Multi, they have incredible metrics as well. So revenue growth of 13 to 15% is incredible for this company. Even in 2020, when they had the COVID lockdown, Multi was still able to grow at around 11%. And besides that, there are profit margins of 50%. It's a drink company having 50% profit margin. And then you have ROIC of 28%, ROC of 44%, ROE of 35%. Overall, the metrics for this company are just incredible. If you were to look at a chart of this company in terms of the fundamentals, it's just a straight line graph to the right hand corner. So for Multi, it is one of the greatest companies out there in terms of the mode of the business. It is sort of like a perfect intersection between Hermes and Coke. They have Coke's brand value in China, and they have Hermes growth and the Hermes premiumization in China as well. So for Multi, I'm thinking of allocating 5% in the stock. Although the stock is not super cheap yet, the stock is still trading at around the 20 times earnings. And for a Chinese stock, the valuation is quite elevated, but it is an amazing buy and hold forever company. It is one of the best companies I've seen out there. For this one, I'm still monitoring it. I'd like to add to this one soon. Next portion, I'll be talking about some Singapore stocks. So this commenter actually said that, can you make an overview of your Singapore holdings, showing some of the tickers and what they do? It's an interesting market I have no exposure to, but maybe want to add to my portfolio. Thank you. So let's talk about some of my Singapore stocks first. So my holdings are mainly in the REIT as well as Singapore Airlines. The airlines portion is a bit weaker than the REITs itself. Most Singapore stocks are high dividend yielding, so don't expect much capital gain from them. REITs have interest rate tailwinds, and that's why I'm invested in them. So when your interest rates start to come down, it will lead to lesser borrowing costs for all your REITs, and that is when you see their net income going up over time, which will lead to an increase in DPU for all these REITs as well. And for a lot of the REITs in Singapore, I still view them as undervalued. They still trade at less than 1 times price to book. And for a lot of them, if we were to see a mean reversion, then there could be a lot more upside ahead. So let's talk about my first REIT. So the first REIT that I own is Fraser Centrepoint Trust. This is one of my larger REIT holdings in my Singapore portion. So they own a lot of the heartland malls in Singapore. And for Fraser Centrepoint Trust, the fundamentals are quite solid as well. And for Fraser Centrepoint Trust, they own a lot of the retail REITs. And for this retail REIT, it is a predictable stream of income that will come in every single year, especially in a country like Singapore where your retail malls, they are almost irreplaceable. The other REIT that I own is CapitaLand Integrated Commercial Trust. This is another one of the REITs in Singapore. They own retail REITs and they own office REITs as well. So if you were to look into CapitaLand's fundamentals this year, they reported their Q1 earnings. The Q1 earnings were quite decent. So tenant sales went up 17% and their rental reversions and their rental portfolio actually went up by quite a fair bit as well. They have rental reversions of upwards of 10% in the retail segment, which means they're able to find new tenants, which are able to provide them with increased rental income. So in Singapore, if you're interested in the REITs, I think the better ones out there are your Fraser Centrepoint Trust, your CapitaLand Integrated, as well as Capo. As for the best performing Singapore stocks, will be your Singapore banks. So over the past 5 years, for example, DBS is up around 129%. So if you're to add in the dividend yield that the company provides as well, it has crushed the S&P 500. But the problem with all your banks is this, they're massively overvalued. So for DBS, for example, it is currently trading at a 1.86 times price to book. So that is comparable to a lot of the US banks like JP Morgan, like Goldman Sachs and so on. And so although DBS metrics are quite great, interest rate cut could start becoming a headwind in the future. When the Fed starts to cut rates, it will lead to less net interest income for all your banks. And that's why I'm not invested in them yet. They're quite high quality in Singapore in terms of the fundamentals. But for now, I'm staying out of them simply because of the interest rates coming down over time. Next portion, I'll be talking about some questions left in the comment section. So the first one, it says, do you think Google or Adobe is more riskier and disruptable in terms of AI? So if you're to compare Google and Adobe, Google has the problem of your LLMs as well as your regulations. And for Google, the management is actively trying to pursue AI, trying to stay ahead in AI. Whereas for Adobe, they're not actively doing so yet. So far, the only thing that they've come out with is your Firefly. And for the company, they're heavily reliant on price increases to basically increase their revenue. So based on my calculations, the company is almost seeing zero volume growth. And for Adobe, if they continue increasing their prices every single year by 10% or so, it could start squeezing their consumers. The consumers could start looking for alternatives. And for Adobe, it is a company that is facing not only AI risk as well, but it is also facing a lot of competition as well. So you have competition from Canva, Figma, and so on. And so for Adobe, I see it as the riskier company that could be disrupted in the future. And that's why I'm not invested in that one. Although the valuation looks quite compelling today, it is trading at around 5% free cash flow yield. But for me, it is a company that is facing disruption risk today, and that's why I'm avoiding that name. Next question is, why 32% cash instead of buying some defensive businesses which don't drop in bad times but still grow somewhat reasonably in good times, and then sell them to convert to cash when buying opportunities arise? So you're not wrong, but there's always a risk when it comes to your defensive stocks. No stock is defensive when a downturn comes. So for example, United Health has always been seen as a defensive compounding machine, but over the past 6 months or so, the stock has dropped around 50% already. So there's nothing that is 100% defensive in equities, and I think collecting the 4% yield right now is okay. As for my cash position, it is slightly elevated, but I'm actively looking for opportunities to deploy in the market. I can't really see opportunities right now, so that's why I'm waiting out, but hopefully they come soon. I hope you guys have found this one useful and invest safe.